today to introduce a friend of mine, Peter Fuhrman, who is not only the chairman and CEO of China First Capital, but also someone who brings really unique perspectives, background, and insights from across his varied experiences around the world, in particular in China. So good morning to our folks in the U.S. And also good afternoon to our audience in Europe, and good evening to our audience in Asia, along with Peter and myself. Just real quickly, so we save time for Peter's presentation, and then thereafter a Q&A. So China First Capital, for which Peter is head of, is a Greater China-focused international investment bank, as well as a principal investment firm. He's based in Shenzhen in China. And China First Capital in particular brings a really unique perspective as it covers both private sector companies as well as SOEs and financial sponsors, including private equity firms and also hedge funds across the country. And it also is involved in M&A, both domestic and international, and covering various sectors, including buyouts, technology, healthcare, and consumer. Peter has commentary, has frequently been included in international media, including the Wall Street Journal, Financial Times, The Economist, New York Times, and locally in China in Caijing, which is one of the leading publications in China. And he's also guest lectured at the University of Michigan and UCLA Business School. Some personal information about Peter. So born and raised in New York, and has first arrived in China over 36 years ago. So quite amazing, I think. Completed his master's degree at Cambridge University. Previously was in the U.S. and Europe, as part of also one of the venture capital funds in California, and also entertainment finance before that, and someone who really enjoys living and working in China and collecting Tibetan and Chinese antiques, in addition to eating and enjoying the local cuisine. So I'm very, very happy and very excited that Peter is able to join us this evening to share his presentation entitled China. I'll let him do the introductions for his presentation. But so without further ado, I'll turn it over to Peter. And thank you so much, and we look forward to your presentation, and we will shortly thereafter include a Q&A. We'll take questions from the audience. Thank you, Peter.
Great, and thank you very much, Trento, and welcome everybody who's dialed in this morning, afternoon, evening. I'm very humbled by the introduction, and will also at least put some of you to rest who heard Trento's introduction. I did in fact first set foot in China 36 some odd years ago, but have not been here continuously. So I do have some on-the-ground knowledge of a world other than that of the Middle Kingdom. And we'll come to that through the course of the presentation. So again, my thanks to Trento for the invitation, my appreciation for all of you making the time today, and very much look forward to the dialogue that will transpire both today or subsequently. If you have questions, I'll be delighted to engage by email. So in the interest of all your other time commitments, whatever time it is where you are this morning, this afternoon, this evening, I decided to distill down to its essence my planned talk on the perils and attractions of investing in China and let you all get on with your day. So here it is. GDP growth has never and will never absolutely correlate with investment returns. Any questions? No? Great. Thanks for your time. Now, I'm of course joking and do hope that to have your attention and solicit your inputs over the next hour. But that key reality of successful investing is all too often overlooked, and China has provided all of us down these last 30-some-odd years with a vivid reminder that IRR and GDP are by no means the same animal. And China really has, in the specific instance of global investors, provided a very harsh reminder of that fundamental investment reality. China is, was, and will likely long remain a phenomenal economy. The growth that's taken place here since I did first set foot in China in 1981 has been something almost beyond human reckoning. Per capita GDP in PPP terms has risen by 43-fold since I first came to China in 1981. And I think it's at least arguably the case, so I'm persuaded of it, that what's transpired in China economically and socially, financially, over these last 35 years is the most important historic event of our lifetimes. Larger, more monumental in importance than the fall of the Berlin Wall, or even the election of a you're up, then you're down, then you're up again real estate developer as the leader of the world's most powerful and richest country. China this year, 2017, will add about $1 trillion of new GDP. Just to put that in context, $1 trillion is not a lot less than the entire GDP of Russia. Indeed, China's incremental GDP growth in 2017, this $1 trillion, will be well above $12 trillion GDP by the end of 2017. So this 1 trillion increment being added this year in 2017 is larger than the entire GDP of all but 15 countries in the world. So who is making all this newly minted money? How can any of us hope to get a piece of it? This is one of the reasons, I presume, why we're all here today, and it's clearly the question that I have been asking myself, well, at regular intervals and struggling for competent answers pretty much since those earliest times in China in the early 1980s. The other reason we're here today is to understand why, if China is such a great economy, it's proved such a disaster area for so many of the world's largest, most sophisticated global institutional investors, private equity firms, Fortune 500s. Horror stories abound. Chinese listed companies in the US and Hong Kong with what seems to be alarming frequency turn out to be more fraudulent than any Enron. It may be true that even some of you participating today have waded into the investment waters in China and unfortunately come back short of a limb or two. Today we're going to try to understand why this disconnect exists between China's robust, phenomenal, dynamic economy and the investment returns to global investors. Why that disconnect is both so striking and so persistent, and ask ourselves if there's anything to be done about it. Though it's been at least 100 years since this was the case, both Harvard and Stanford, the universities, were built in significant measure on huge gains made from investing and operating in China, with those gains then obviously donated to build the universities. It was certainly a lot harder back then, at least 100 years ago, when China was the poorest of the poor, a charity case as well as a basket case, and being torn to shreds by revolution and civil war. So if significant investment results could be achieved during those most challenging times in Chinese history, from the middle of the 19th century to the middle of the 20th century, we should at last now have both the perspective, the opportunity, the discipline, the mindfulness to find a way to prosper as these earlier generations once were able to. So let's start by setting the stage. What makes China especially challenging for Western investors today? Let's start with the fact that China is a part of the WTO, the World Trade Organization, but not entirely of it, not fully subscribed in any way to the notion that reciprocity, openness, free trade, level playing fields, equal treatment are positive ends unto themselves. China, following an example first demonstrated successfully in neighboring countries, Japan and Korea, has at its core a mercantilist outlook that says that the more gains that can be accumulated domestically in a zero-sum environment, the better it will be overall for China. As China has gotten richer over particularly these last 20 years, it has seen even less and less need to attract foreign capital and foreign investment. That's a tendency we see in other countries, including obviously some of the rhetoric we now hear in the U.S., that more of the gains of a national economy should belong to its citizens. So there's nothing that we could say was any way particularly unique about China having this fundamentally nationalist outlook on their domestic investment milieu. But China's way of going about making the market both a challenge for foreign investors and a playing field for its own domestic ones is different than examples we've seen in Japan, Korea, and elsewhere. So let's look a little bit at some of the specific challenges that have made China traditionally such a difficult place for foreign investors, while at the same time, at least to appearances, one where domestic investors seem to be doing remarkably well. Let's start with the currency, the renminbi. I think everybody on the call understands it's a closed, non-tradable currency. For at least 20 years now, China has, at the urging of the U.S., the OECD, and elsewhere, been committing to a process leading to free convertibility of the renminbi. And there were certainly times in the recent history, 5, 6, 7, 8 years ago, when that looked like a more likely near-term outlook than it certainly does today. There's no sign that the renminbi will become a fully tradable international currency anytime soon. And that means that getting USD as an investor, getting USD, US dollars into and out of China has always been difficult and remains difficult. It's a managed currency. It moves up and down not entirely based on any investment or economic fundamentals. So it's impossible for investors to hedge or to predict with any accuracy the direction that the currency may go. A vivid reminder of that is the billions of dollars lost by what were allegedly some of Wall Street's smartest hedge funds over the last few years, who almost unanimously took a bet that the renminbi was going to fall dramatically during these last 2 years. And in fact, it's in the last year now, it's appreciated slightly. So currency is and remains a challenge for any investor, how to lock in dollar-based gains as dollar-based investors. The next imponderable or challenge that China presents that in its essence is unique compared to other markets in the world. It has now the world's second largest capital market, stock and bond markets, but those stock and bond markets are largely closed to any investors other than Chinese domestic ones. And even among the domestic investors who are now have poured trillions of dollars into the stock and bond market here, a notable difference between the source of funding for the capital markets in China and elsewhere is that somewhere between 70 and 80% of all money invested in and out of the stock market in China is retail investment. In other words, individual investors speculating, gambling, rather than investing alongside fundamentals. I think everyone would acknowledge that. It's not a stock market that in any way can be understood to follow investment fundamentals as they're understood in any other markets. So insider trading, front running are commonplace. Even as China in the last 2 years has lightened up the rules to allow more Western institutional investors to invest directly into Chinese quoted equities, it's notable that very few have taken up now this offer to put some money into China's capital markets. It's just simply too unpredictable to try to derive value and a purposeful and successful investment strategy. So it's a challenging environment for anyone to be a secondary investor, a second-hand market investor, but China also remains unique in the fact that as a primary market, an IPO market, it continues to provide companies going public with by far the highest multiples anywhere else in the world. A third difference that's constituent in China, deeply held, likely not to be changing anytime soon, is that M&A transactions remain rare. So they remain rare as a source of exit for institutional investors, and they remain rare overall. That's partly a function of a two-speed China economy. When I first came to China 36 years ago, China was 100% state-owned. 20 years ago, the first rules were put in place to allow a private sector to function. So at that point, even as recently as 20 years ago, the economy of China was basically 100% state-owned and 0% private. Today, according to anyone's best estimate, it's about 70% private, 30% state. And most of the value creation, most of the dynamism, most of the fulfillment of consumer wants and needs is being provided by that private sector economy. So in theory, there should be very interesting M&A opportunities targeting some of these more successful private sector companies in China, and Fortune 500 companies have been mindful of this, at least for the last 15 years. It's been exceedingly difficult to get successful transactions done. There are many reasons, but one of the core fundamentals here in China is that, by and large, all private sector companies in China, large and small, are family companies. They are run by generally a father or a mother who is surrounded by various family members. There is a very light tradition, to the extent it exists at all, of professional management. So in acquiring even what appears to be a very big, thriving private sector company, the new owner often will find that it's extremely difficult to manage it. The other thing, which is the fourth one on this particular slide, it will be, I promise, the only authentic Mandarin word I will rely on this morning. You'll see it's there. It's called guifan. What are the rules and who follows them? So guifan is the Chinese way of explaining the extent to which a company in China is abiding by all of the rules of the road. Those are the rules of the taxes you should pay, the environmental and labor laws you should follow. And by and large, for private companies in China, the extent to which you are adhering to tax laws, environmental laws, labor laws, is a subject of negotiation between you and your local government. It's not at all uncommon that very successful private sector companies in China are successful by virtue of having negotiated with their local government that they will pay little or no tax on their corporate profits. Now, of course, for foreign invested companies, either when foreigners are investing for a minority or when they own the business in China, it's an entirely different story. Foreign-owned companies, foreign invested companies in China are by and large 100% guifan. That is to say, they are 100% compliant with the written rules in China on tax, environmental, and labor. And this has enormous impact on the operating performance of any company in China. So you can imagine how potentially skewed the competitive environment becomes when a foreign invested company is abiding by all these rules. And keep in mind that corporate taxation in China is, at least in the aggregate, if not the highest in the developed world, then among the highest. And the environmental and labor laws are every bit as difficult, every bit as rigorous and tough and expensive to implement as they are in the U.S. But again, they're lightly followed by all except a select number of companies in China. And so getting it right, being a company that, as a foreign invested company that is abiding by the tax, labor, and environmental rules when your competitors are not, and trying to still stay in the game, has been a consistent challenge. The reason, in case you're wondering why the local government and government in general in China takes such a what would I say, lackadaisical attitude towards the payment of corporate taxes, except for publicly traded companies, is that there's a recognition. Obviously, China is a country where local government officials are scored. The success of their time in office is overwhelmingly attributed to GDP growth. And it should be no surprise if what we're trying to do is optimize GDP growth, the percentage of a company's income that goes back to the government in taxation can have an adverse effect on that. Instead, the government will continue to urge its companies, local companies, to take the money and rather than pay tax, to continue to invest, expand, and therefore build local GDP. Again, it's something that's a unique component of China's growth story over these years. So let's look at what now I think can be called a bygone golden era of foreign investment in China. We're going to pick up the story about 15 years ago, as I said, when the private sector economy in China first became legalized and some large companies began to appear on the scene. So 15 years ago, China was an equity capital-starved country. There was very little surplus within China, very little appetite domestically among Chinese investors, individual and institutional, including insurance companies, to invest in up-and-coming growing private sector companies in China. So the Chinese government allowed global private equity companies to land successfully in China and to invest. And invest they did, and invest they did on a highly, highly successful basis. So I think everyone's top 10 list of most familiar private equity and venture capital firms, so the Blackstone, Carlyle's, Goldman Sachs, Blaine, Warburg, TPG, they were all in this first oncoming rush of PE investment in China. They hired largely Chinese, national, U.S. MBA-educated people to run their businesses here in the early years. And what they found is they brought their dollars in. They were allowed a preferential process through which they could convert their dollars into the renminbi needed to invest into some of these, at that point, still very young and dynamic new private sector companies. They were able to get the money in at very low multiples into what were already quite successful companies. And then within short order, sometimes in as little as 18 months, we're able to exit from those investments by having successful IPOs in either New York or Hong Kong. And some of the companies that benefited from that first wave of Western PE, successful Western PE private equity investment in China, were some of the Chinese companies should be familiar to everybody on the call. So that was Baidu, Alibaba, Tencent, Ping An Insurance, the biggest bank today in the world, ICBC. So by the standards of global PE or VC investing, this was really easier than stealing candy from a baby. You were investing into substantially de-risked, larger, fast-growing companies that already had very profitable lines of business. They raised a little bit of third-party outside money as a prelude, and if you want, as a prestige factor for an oncoming international IPO. And in the course of so doing, the lucky investors who got into these early deals were routinely able to make 4, 5, 6, 7, 8 times their money on any individual deal when the deals went well. And they did go well far more often than not. And as a result, all those very large, well-known, both the big PE firms as we know them, but as well as famous Silicon Valley venture funds like Kleiner Perkins and Sequoia, were all here in that early wave. They did phenomenally well in that first and early generation and used that early success, and they were perhaps lulled into a state of overconfidence to raise far more money. By some estimates, over the last 10 years, international dollar investing PE and VC funds have invested anywhere between $50 and $75 billion in new capital to invest in China growth equity. But what's happened over the last few years is those global giants, the brands that we all have grown to know and admire, have effectively, despite all their early success, been sidelined. And like deposed royalty, these days they seem rich, nostalgic, melancholy, and rather idle. Let's try to explain why that is. today there are more renminbi funds in China probably than there are PE and VC funds in the rest of the world combined. The reason for this is pretty simple, that the Chinese government and gradually Chinese institutional investors noted the success of those first arriving international global PE funds and decided they wanted in on this action. Everyone by then had more or less codified what amounted to a successful strategy, which was, again, invest into a large de-risked company on the verge of an IPO. An English term that's come into common parlance in investment Chinese over the last few years is the phrase pre-IPO. It's called pre-IPO investing, which means you try to do a final round right ahead. Very often the first round these private companies have ever done will be right prior to an IPO. You invest in at a single-digit PE multiple that year's, and you exit at at least double-digit multiple of the following years after another 2 to 3 years, during which time the company is still growing well because it's had the use of the PE capital during that interim phase. So that basic strategy of multiple arbitrage, of going in at a lower multiple and exiting in a few years' time at a higher one, was something that Chinese investors quickly cottoned on to. And when renminbi funds began to be established, and by this day no one knows the exact count, but there are clearly more than 1,000 active today in China, they're all more or less following that same strategy, trying by hook or by crook, by luck or by intuition, to find their way into a Chinese company that is being prepared for a successful IPO. It sounds simple, of course, because that multiple arbitrage opportunity is so attractive that now when companies in their early years, they obviously were mainly going public in the U.S. and Hong Kong. These days, about 6 years ago, China started to allow private sector companies in China to go public in China, and the average multiple at IPO in China is now at least 40x. So generally, I think everyone could see if finding a good company, solid company, profitable company, if you could invest in its single-digit multiples and exit at 40 in 2 years' time when the company was substantially larger than it was a few years ago, that should be a very good way to make money. So renminbi funds began both to be established and to find a very easy pathway to raising capital locally. And in doing so, they started with an enormous advantage. They were raising renminbi rather than having to rely on dollars, which then needed to get transferred in and out of China. And while in the early years that was a fairly easy procedural matter to get dollars into renminbi and then from renminbi back into dollars, it's become more problematic, slower. And so renminbi funds began with a core advantage. They had the local currency in their hands. They didn't need any official approval to invest in a company, so they were able to act more quickly. Simply, it was easier to get money into attractive companies. Largely, the LP base in China has been made up of government funds in one form or another, either direct from government agencies and government capital allocations, or via state-owned enterprises in China that had accumulated a surplus and were encouraged to invest that surplus into promising domestic companies in China. Chinese LPs also stand out in a global context as being at least motivated by slightly different concerns than insurance companies and endowments, pension funds, and in the rest of the world. Government funds participating in, as LPs in renminbi GPs and renminbi PE and VC funds are not always or even primarily concerned about earning an IRR. They want the investment to do well. They don't want to lose or squander government money, but it isn't an absolute core essential that they optimize or maximize return. The money is being distributed and allocated through the mechanism of PE firms to promising domestic companies, also in part to achieve policy goals. The China government is, of course, very active in guiding the direction of its economy. Most recently, obviously, in the biggest picture, it was to transition China from a low-margin, export-reliant export OEM economy to an economy much more focused on the domestic consumer economy. And so as it's making that transition, China is allocating money centrally, both directly in terms of its own spending priorities, but also through renminbi funds, some of which are government-controlled, some of which are private, but a lot of the capital, again, is ultimately government capital. They're doing so under the remit that investing should be appropriate and consistent with the overall goals of the country. So among these renminbi funds, they all are following the same strategy, pretty much. That the idea of contrarian investing, at this point in China, that would mean investing in, let's say, what we call traditional industries in China, manufacturing companies, basic consumer goods companies, is so out of favor at a time when almost all this enormous weight of renminbi funding activity is going into the same, what we broadly call TMT opportunities plus healthcare. So the overall spectrum of investable companies in China has shrunk rather notably over the last 5 years, as the government has more clearly articulated the direction it wanted the economy to go. And all PE firms in China largely hear what the central government is asking for, and when being told to jump, simply respond to how high should I jump. All PE funds, renminbi PE funds in China, claim the same kinds of magical powers to influence the decision-making process over which Chinese companies should be allowed to IPO. Let me stress that because, again, it can be a little counterintuitive to people not overly familiar with the functioning of China's capital markets. The pace, timing, and number of IPOs every year in China is not dictated by the market, but by bureaucratic fiat. There are anywhere between 500 and 600 companies, Chinese companies now on the formal waiting list, waiting to be allowed one of these slots to IPO, and several thousand now waiting in the wings to be allowed to have their applications accepted to join the waiting list. Why wait in the waiting list when it's uncertain you'll ever be chosen or at what point? Because, again, the multiples that IPOs are attracting in China remain by far the highest in the world. And there's functionally, for a company having an IPO, no risk whatsoever, also for the underwriters. Shares at IPO in China are simply placed. They're not sold. IPO is a scarce resource. This year we're on path to have more than we've had in recent years, but still probably won't exceed 300 in total, when the market, obviously, at least in its current form, if the market were dictating, could absorb far more. But the government is trying to balance, as it sees it, up from a helicopter view of the capital markets, supply and demand. It wants to ration out the number of IPOs each year in China to a precise but largely non-scientific basis to have just enough to allow new companies to enter the market and get funded, but not too many that it would put overall too much supply into a market and therefore influence the overall performance of the stock market index in China. Chinese central government is intricately and intimately concerned with the overall performance of its stock market index. So what makes investors here different than in other parts of the world? One of the things we've come to understand in China is that this is a market where fiduciary investing, as we understand it in the West, has largely failed to take hold. It's primarily an Anglo-Saxon creation. It's proved hard or challenging to transplant to countries like France and Japan, and far harder now in China, where there's little formal rule of law. The persistent problem among all GPs, including some of the dollar-based ones, is that they are not always acting as they should as good fiduciaries. PE funds, VE funds, and VC funds in China, though structured according to the U.S. model as partnerships, genuinely are not operated like it. There is partner turnover in China in PE and VC firms, unlike anything that one would encounter in other parts of the world. The key reason is, though called a partnership, almost all of the larger funds in China are really operated with a prima inter pares, a top dog, an emperor. There is one core guy who started the fund, raised the initial capital, and though there is often an IC, a formal investment committee, to act as a fig leaf, the firms overall tend to follow the exact decision-making and direction of this single most important partner, founding partner. So to be a partner, anyone other than that top dog partner, isn't often a very appetizing long-term position for what become experienced Chinese equity investors, and they will often then, as soon as they're able to, go off and set up their own funds. So this process through which GPs, PE and VC firms are founded, splinter, create new ones, has an unparalleled speed and consistency in China, not seen elsewhere. So the result is that we have a form of portfolio structuring and portfolio management that, again, in China is rather unique. That since there's one guy at the top and he's mainly concerned first and foremost with gathering AUM, not necessarily with, which is assets under management, not necessarily with trying to earn a return from successful investing, that what we now have is large portfolios across renminbi and dollar funds of unexited investments, what have been called in the U.S. context zombie funds. There are far more of them in China than in the U.S. It's a problem, it's a challenge, and it's led to a great deal of LP frustration. And changing that culture, trying to inculcate a culture of fiduciary investing, principled investing, to focus more on being a successful investor rather than a gatherer of AUM, has still been proving to be a challenge in China. So though we've been talking about what a tough environment it is in China, let's look here, though the print is small, some of the reasons to stay engaged or even to try and find a viable investment angle. GDP growth we covered. This year, new GDP, incremental GDP of $1 trillion, China likely to continue to grow by at least 6% a year. The second one on this list is that for all of the predictions of an imminent collapse in China, imminent economic catastrophe, financial catastrophe, local government debt, bank bad loans, all the bad lending, all the rest of it, up till now and across my 25 years of involvement in China, every one of these predictions of imminent collapse in China has proven to be false. So it appears that China does have some resiliency, and it is certainly the case that it has a government that has the tools and the financial resources to ride out most challenges. Now, that's not to say there aren't lots of imbalances and risks in China, so bad outcomes are clearly still possible at some point. But again, keep in mind the government does have the tools. And when you read, as you will probably not long after we get off the call today, about imminent problems, and the most recently stressed one is in the problem of bad debt in Chinese banks leading to a financial collapse, just run the disclaimer through in your own mind that someone like me who's been reading these articles for the last 25 years will have found both a consistency of approach, a consistency of expectation of catastrophe in China that has not yet been forthcoming. Third factor that remains an interesting dynamic in China is the way that the stock market functions here. As long as China remains a closed economy relatively, with a closed economy and a closed currency, it's likely that there'll be a big valuation gap and that Chinese companies will continue to be valued more highly than comps elsewhere. That makes it an interesting market to try to finance yourself through an IPO. And then again, one of the really heartening themes of China, the impressive and awesome themes of China over the last 8 years since I've been here, is how effortlessly it's made the transition that still bedevils lots of parts of Europe from a smokestack economy to a consumer spending paradise. China has been doing this now successfully, making that transition faster, smoother than I think any other country in history. At this moment in time, every major consumer market in China is booming, both online and offline. Online, what's happened with Alibaba, Baidu, Tencent is truly remarkable. And those three are now operating as three of the single most profitable companies in the world, each of whom enjoys something like a monopoly, either over e-commerce, search, or what we now call through WeChat, social media. There's never been a better time in Chinese history to be a Chinese consumer. Almost everything that Chinese consumers want to buy now is either far cheaper than it was because of Alibaba Taobao, or is being subsidized like rental bicycles now in China by tolerant VC firms who are hoping someday these firms will turn a corner and earn some money. I was lucky enough to be in a city in China called Wuxi 2 days ago for a World IoT conference at which Jack Ma of Alibaba was a speaker. And he made a point to this very august audience of mainly government and business leaders that is one that is not often stressed in China, and coming from the most successful, arguably the most successful of all the online entrepreneurs in China. I think it was very focusing and very appropriate, because he said, you know what, China, we still have many areas of economic opportunity. Not everyone should be piling in to the online economy, because as he said, though it's a very dynamic part of the Chinese economy, there are only 5 companies in China, including his, that are really making any money doing online business. So he's still urging, and we do as well, people to stay close to consumer trends and consumer markets, and that means very often the offline market. Some people may be trying to understand, as China successfully made this transition to a consumer-driven economy, where is all the money coming from? Salaries still remain very low in China by international standards. The easiest way to understand how China has a robust, booming consumer economy, as well as an enormous appetite for luxury brands, yet on average salary levels that are still 1/5, 1/6 the levels in the U.S., the simple answer is that almost all Chinese now living in urban China, and that's half the population compared to about 15% when I first got here, owns at least a single apartment, if not multiple, which is more common. And the single best performing investment asset in history has probably been Chinese urban real estate over the last 30 years. It has gone up almost without a flinch over those 30 years. And across, different cities have accelerated at a different pace. It'd be fair to say that the average appreciation over the last 10 years has been at least 300%. And again, up till now, domestic real estate has never experienced anything like a downturn. There's only occasionally been a slight slowing. So now we're going to turn to this most focusing of all questions, which is where and how and is it possible to make money in China? A few quick thoughts. In China, one message above all: active investing beats passive investing every time. Illiquid portfolio investing here, expecting returns to come by way of a share purchase agreement, has proved to be largely a fool's errand. What you need to do is either be the owner-operator in China or be a close strategic partner with one and stay actively engaged. So the good news is there are a core of foreign companies, large and small, thriving in China. The market in China, the consumer market, is moving overwhelmingly towards high-quality, premium brands and services. Some markets, like financial services and e-commerce, are closed or filled with obstacles that make it difficult for foreign investment to enter, but they're usually workarounds, and most of the rest of the economy is open. Anything touching upon or trying to fulfill consumer demand in China, there is a market here growing already into enormous size. And among the companies listed there that are doing well, there may be one that's on that list that few are familiar with. It's Z-H-O-N-G-A-N, pronounced Zhong'an. And it's on that list for 2 reasons. First, I'm lucky enough to know the founder and admire him enormously. And second, it's a company that was started by an HBS grad, an HBS and an HLS grad. In fact, as it happens, he's a Caucasian, like me, a New Yorker, a Jewish white New Yorker, came to China many years ago, long before I did. And he now owns and runs one of the largest non-bank lending companies in China. It is an extremely native business when in China. It has nothing to do with global products or services. He got deeply involved, my friend Paul, the owner and CEO of Fuhrman into a very challenging environment of making smaller, non-securitized loans to Chinese small business people, but he does it in China, across China, better than anyone else in this country. So though China has a population whose incomes on paper look like the people flipping burgers at McDonald's, they seem to have the spending power and love of luxury goods like the people summering in East Hampton. And in terms of the consumer economy, we convened today on what's become arguably the most important day in the Chinese consumer calendar, the day when Apple announces its new iPhone. Make no mistake, China is the market most in love with Apple. If there's a better example of consumer market preference, power, and trends, it is Apple. Even Apple itself has no idea how big its market here in China is. It's likely that at least 100 million iPhone 8s will be sold to Chinese over the next year. It's impossible for Apple to calculate because many of the Apple iPhones used in China are bought outside China, since the price in Hong Kong, New York, or Europe is generally 20 to 40% cheaper than the retail price in China. Chinese, when they buy their iPhones, they buy them for cash, by and large, not with any carrier subsidy. And Apple's been able to achieve this phenomenal success in China. What they calculate, at least the transparent number, just sales within China itself accounting for over 30% of their revenues. It's achieved all this with almost no advertising here in China. It's similar in that sense, but I guess the far most successful case of all to other successful foreign brands. Its margins are fatter and its expense is lower in China than in any other major market where it operates. Where will money be made in the future? There are 4 major areas of opportunity. The slide here provides them each by name with a quick summary rather than go through them in the interest of time. I urge you to spend a little time looking at them or email me if you're interested and I'll send you the entire deck. 4 major areas of investment. You want to be in anything that's directly touching on these 4 or tangential to them. Now, to be sure, for anyone investing in China or seeking to operate a business here, Chinese competitors are tough, but they can be outcompeted. That's the story of the successful foreign brands here. Chinese companies tend to suffer from an inability to create strong, durable, quality brands. There is one exception, at least in the making, that I urge people on the call tonight to pay at least some attention to, and some of you may have heard of. It's a Chinese mobile phone brand called OnePlus. It was started 3 years ago, and in those 3 years, it's done what no other Chinese mobile phone manufacturer, no other Chinese electronics company, or indeed no other Chinese company that I know of has ever dared, which is to focus its efforts successfully on selling to the U.S. and Europe, not selling based on price, but on quality, design, and attitude. OnePlus is really a sign that China is these days creating some, though not large enough in number, it's creating some fantastic stories of entrepreneurial success, even in very difficult environments like selling mobile phones in the U.S. So I'm sure by this point I've neglected to give anybody any greater understanding about how I spend my working day here in China. Again, as Trento was nice enough to mention, I was born in the U.S. I first came to China in 1981 as one of the first intake of American graduate students. It was a real eye-opening experience arriving here in 1981 to find a China far poorer and far less of a happy land of Maoist happy brothers than I was taught in the university in America to expect. It then turned out by an accident of timing as well as an early career choice I made to be a foreign correspondent. I was in Beijing, Tiananmen Square during the massacre. So I've seen China, let's say, evolve through a very different states of being, and have now that I've been back in China full-time for the last 9 years, really, with the benefit of a fading memory, still able to conjure up recollections of a China that was statistically 1/43rd as rich per capita as it is today. China First Capital, my firm, operates, as Trento says, according to a merchant banking model, acting as advisors and principal investors. There aren't many other companies doing this in China. And we're lucky enough, I speak some Chinese, to know well and work with the leadership of quite a large cross-section of the best companies operating in China, both domestic and international. There are always good opportunities here in China. We try to stay focused on the ones with high sustainable margins. Sounds obvious, but not often at the top of other investors' priorities, especially renminbi investors. We have our toes as a firm into quite a few different areas in China, including those on those previous 4 slides of the slide of the 4 areas of focus. I can make a quick mention because we've discussed it publicly about one area that we're active in and very excited by, and that is the market for professional global standard Alzheimer's care in China. The U.S. has about half the number of Alzheimer's patients as China does today, about 4.5 million in the U.S. compared to 9.5 million in China. The U.S. has 73,000 specialist Alzheimer's treatment care beds. China has fewer than 200. Alzheimer's care is a $250 billion industry in the U.S. In China, it's barely even begun. The potential for building out a chronic care business in China is enormous. The challenges are large, but the need is also large. So finding those all coalescing together, which is a very attractive, ripe market where there are very few, if active, incumbents, and a business area that both has a long-term growth potential, since the number of Chinese expected to have Alzheimer's, sadly, by the year 2050 will grow from 9.5 million to 45 million. Market is enormous, and the social good that will follow from entering that market is also very high. We're based in Shenzhen, which is a city in the southern fringe of China, attached to Hong Kong. This is the city where China's capitalist transformation started. It's still the richest, freest, and most market-oriented city in China. And at least as of today, 2 of China's 3 best companies by wide acclamation, Huawei and Tencent, are Shenzhen-based companies. Shenzhen also has more private sector listed companies than any other part of China. Personally, I feel like I've burned my boat. I hope that I'm here for the duration. I'm challenged by living in China, but enjoy it enormously. So finally, with abundant humility, let me finally try to sketch out where China overall may be headed. China always fails to live up to other people's fondest dreams, including American presidents like Bill Clinton and George Bush, who had hoped explicitly that China would become something more like a U.S.-style democracy. Hasn't fulfilled those dreams, nor has it fulfilled some people's worst fears and predictions. So how will China move ahead from where it is today? More haste, less speed. Meaning the overall rate of GDP growth is unlikely ever to rival that of a few years ago of 10 to 12% a year. But overall what we have is higher quality growth. People in China now are living well. Things in China should continue to motor along very smoothly, at least for the next 25 years, at least for one more generation. The upcoming generation of China are better educated, more skilled, ambitious, globalized than their parents. It's a bigger generation gap here in China than anywhere else in the world, because there's so much wealth now in the hands and sophistication and opportunity of that younger generation that their parents could never have dreamed of. Looking ahead 25 to 30 years, sadly, China will likely suffer a demographic disaster. This country will become a very old society very quickly. That's the inevitable product of 30 years of a one-child per family policy. By 2040, 2050, 25% of China will be over the age of 65. China will be an older society than Japan is today. And we've seen what having a high percentage of retirees and old people to care for does to overall GDP growth in China, in a country. Which is to say, looking at Japan, there's been very little GDP growth over the last 30 years. Another major theme to keep an eye on is that China is feeling and asserting its power as a globally important and now middle-income, rich, and fast-growing economy. And everywhere it looks globally, it runs up against the U.S. From the perspective of Chinese leadership, they're feeling like they're being blocked or impeded in some ways by U.S. power, while the U.S. views China as a power, a non-democratic power allied to most of China, most of America's worst enemies, and that this is a power, China is a country that the U.S. views that needs to be contained. Luckily, there are lots of ties, both personal and economic, between China and the U.S., so we should all hope that nothing goes wrong, but there's always a possibility. It's called technically the Thucydides trap, the idea that the U.S. and China are fated to clash. Let's all hope not. So for more trade, more exchange. The good news is, living here, U.S. influence is deep and profound, positive, even though the Chinese government tries to push the population in the other direction. Finally, a last summons to all those on the call with me today. Why be active in China? Why give it any consideration as an investment destination? China is, as I said at the beginning, the biggest story of our lifetime. Chinese are still probably not as free as many of us would like, including many people here in China. But there's no denying the reality of what a better, happier, freer, richer country China has become since I first set foot here. I marvel every day at the China that I now live in, even while I occasionally curse some of the unwanted byproducts like heavy pollution in most parts of the country, overcrowding at tourist attractions, bad traffic, a pushy culture that's lost touch with some of China's ancient glories. Still, China will continue to amaze, inspire, and stupefy the world. Chinese themselves, through this period of a 43-fold increase in per capita GDP, have themselves done very well and will do even better in the future. At the same time, those of us investing in China may do a little bit better here in years to come than we've done up till now. And we can hope that some of the newly minted trillions in China just may end up sticking to our palms. Thanks, everybody, for your patience, for your attention, for the acceptance of the fact that sadly I had to be rather cursory about many topics today that deserve lots more detail. I'm happy now to answer any questions. And if not this evening, this morning, I'm happy you'll see my email has been available throughout on each slide. You're welcome to email me with any questions, comments. You'll see the email there, as well as, if you like, there's now on this final slide the opportunity to download the deck. My thanks again to everybody, and welcome the opportunity for a dialogue.
Wow, thank you so much, Peter. I have to say, probably on behalf of everyone on the call, most of all myself, that was really quite illuminating and fascinating. I think you really show a strong command of the China market over the last 2 to 3 decades, from geopolitical, economic, financial, and entrepreneurial, as well as social angles. So thank you so much, Peter. Really, really great presentation. I think we have a few questions, and I know we're coming on time, so perhaps we can get to several. Peter, just maybe one question to start us off is, in terms of, as we begin to see now, as you say, China flexing its muscle in terms of industry, building up industrial giants to comparable, let's say the China, the Amazons and even the Googles and the Facebooks of the U.S. With its own industrial giants and its shift to trying to build these these national champions, if you will, and with the government national policy clearly oriented toward in favor of the domestic players over multinationals, which have been perceived to be reaping kind of undue gains for far too long. What would be your advice to foreign companies, or even, let's say, on the buy side with private equity firms, in terms of penetrating into this next phase of the economic development?
It's a great question, and obviously I think you can come at this from multiple angles. An important one is to never bet against the direction that the Chinese government wants to lead the country towards. But I think as China evolves, as it grows more sophisticated, I think it is notable, though it has large successful domestic companies, particularly the BAT, Baidu, Alibaba, and Tencent. It's notable and emblematic that those three really don't have any international presence whatsoever. There are many reasons that we don't have time for tonight. But the reality really is that high-quality manufacturers, service providers, consumer brands still enjoy a very strong market demand in China. So while the government is hell-bent on trying to upgrade the overall quality and sophistication and innovation levels within China, there's so far, again, it's unfalsifiable what happens in the future, but so far, up till now, very little to show for it on the ground. And there are good reasons. Look, the U.S., Europe, Japan, Korea have been at this process of incremental innovation and improvement for the better part of 20, 30, 40, 50, 60 years, and have produced in brutally competitive global markets some really great companies with very sophisticated globalized management. China does not yet have that. And to the extent it can achieve it at all, it's still going to take time. Net, what it means that if you're in the group of the best providers of any product or service or technology, China is still going to be a market. They might have their jaw clenched out of regret that it can't all be sourced domestically, but the reality is that it can't. We see that over and over, particularly in high technology. So while it's a challenging environment, what I would say to everybody is that have faith that your products will still be able to succeed in this market, whatever kind of national industrial policy China's central government chooses to follow.
Great, thank you, Peter. Our next question also comes from the audience. The question is that for those companies who have been offered access into the China market, but in exchange for teaching or instructing local companies their certain knowledge or know-how or IP, how can these foreign companies proceed to protect themselves and their assets or technology?
Great question, Trento. Partly this is a legacy of a China that's now long gone, which was the first generation of some larger, sophisticated foreign companies, particularly auto, electronics, early-stage technology companies like Hewlett-Packard, were made to accept that Faustian bargain of technology transfer in order to gain access to the China market. It still does take place. We've seen some pressure put on firms like Intel, Qualcomm, and Cisco to turn over more technology. The reality is, I think when you talk to these companies, they regret that the policy is even spoken about. It hasn't had the intended outcome that those Western companies, look, they end up transferring, of course, and the Chinese know that, not their very latest or best technology, which is why 20 years along, though China tried to use this policy to create domestic car companies that could rival the best of Japan and Korea as export powerhouses, China is still a large car manufacturer, but almost unable, its domestic car manufacturers, to export. So what I would say is it's becoming less of an issue. It still exists in certain pockets of technology. I think in practical terms, it's less of a detriment. But I do think at least now the U.S. government is speaking very forcefully and consistently about why this is contrary to the spirit as well as the letter of WTO laws. So in individual company circumstances, you try to work out something in the best way you can, but we haven't seen it actually function recently as a real debilitating challenge for talented Western businesses operating in China.
Okay, great. Thank you, Peter. Another question from the audience, this one seemingly from the buy side. So one of our listeners or viewers has been fundraising for a venture capital fund in China and is familiar with the recent capital outflow restrictions. There has been some word that the Chinese government is considering lifting these restrictions for certain types of investments. What are your views on the short and long-term capital outflow restrictions for funds, especially focused on healthcare?
Okay, obviously, I see a lot of hope here rather than anything that would qualify as a genuine signal that these very tight restrictions put in place since last November are going to be lightened up in their ominousness. But the reality is there's actually very little sign that's happening. In other words, there's a large embedded constituency of people who want the rules to be liberalized again so Chinese can get more money out of the country and buy assets or invest in entities outside of China. but I think the reality is that China suffered from what they considered a precipitous drop in their foreign exchange reserves when too much money was allowed to exit. They are now going to, on a deal-by-deal basis, continue to control things very tightly. And it's now within the last month they articulated very specifically the kinds of areas where money will be allowed legally to exit China. And in terms of fundraising for portfolio investing via a U.S. GP or an international GP who's investing in those domains into sectors that aren't immediately of primary importance to China's growth strategy, it's challenging today and will remain very challenging. As China has said very clearly that geographies it wants Chinese investment flows, global investment flows to be most focused on are those that we now know under the rubric of One Belt, One Road, which is Central Asia, South Asia, Middle East, and Eastern Africa. So that kind of rules out the idea that there will be any near-term lightening of the tight controls imposed on the official export of capital in the form of either acquisition capital or LP capital. That isn't to say that, there are many Chinese investors that one way or the other have dollars either currently or available to them through funding sources outside China. They will remain active. But the official flow through the official channel through which renminbi are converted to dollars, my supposition is that it will remain extremely tightly clamped down for the foreseeable future, meaning years, not months.
Great. Thank you, Peter. And so we perhaps have maybe one last question or just time enough for that. Last question is, in terms of the excellent segue, as you mentioned, the One Belt, One Road, with this as well as the, the increasing pollution and beginning budding of some green movement, whether it's air, water, or overall pollution to the environment, do you believe that these initiatives by the government are intended more to stimulate economic development domestically, or are they more an instrument for geopolitical influence, especially in the current Trump era?
Interesting question. So there are two things it sounds like to me to parse here. First is One Belt, One Road. Overall, I think this is more geostrategic than economic. In other words, it's China trying to find markets of opportunity where the rules of the road aren't set or determined by the U.S. and the WTO. They're not great markets. China is well aware of that. They'd much rather be selling into open and welcoming markets in East Asia, the U.S., and Europe than trying to sell to the stands, but they see these as markets where perhaps they will enjoy some incremental growth as well as some geostrategic influence, which is of primary importance. So yes, that will remain a consistent focus of China as it kind of hunkers down and feels the weight of opinion within the U.S. and its allies turn ever more suspicious of the uses and aspirations of Chinese power. In terms of green movement, pollution has become, it is far from just an incipient green movement. It is very much on the minds of just about the entire urban population of China that things need to get better, and the sooner that happens, the better. And there is some sign. That's what the government's saying this weekend, that intended to phase out at some point all internal combustion engines in favor of electric cars. All the other things it's doing to try to first stop the increase of pollution, to stop it where it is, and then to gradually diminish it. The government is actively seeking to achieve results here, but it will take time. It's challenging, and as someone living day-to-day in China, I can only wish that the speed of it was much more evident than it seems to me on a day-to-day basis. The main reason now, a core reason for severe ambient pollution in Chinese major urban centers is no longer proximity of coal-burning electricity factories. It's just simply the fact there are so many new cars on the road. China has by far the biggest car market in the world. It will sell 30 million new vehicles. Those are almost net new vehicles, not replacement vehicles. So every year there are just that many more petrol-burning cars on the road in China. Quality of gasoline here is poor. It creates a lot of particulate matter, so the gasoline needs to get better. Cars need to become cleaner, but it would be commercially and politically suicidal for Chinese now to say to its population, you know what, just as you're able to afford it, we're going to make it impossible for you to own and drive your own car. That just can't happen. The auto industry here is already too important. So how to get people what they want, which are cars, but to have them burning cleaner petrol and more of them driving electric cars is clearly the direction China wants to go, but it will take time.
Great, great, well said. And indeed, everything in China has proven it is taking a lot of time. So with that, last question, Peter, we greatly thank you for your time this evening. Thank you so much for your very insightful feedback. The presentation will be made available following this webinar today. I'd like to thank the audiences in the U.S., in Europe, and in Asia. With that, we will bring this webinar to a close. Thank you so much, Peter.
Thank you. Good day, everybody. Bye-bye.
Yeah, thank you. Good evening.